and welcome to Market Domination. I'm Julie Hyman. Alexandra Cannell in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell on Wall Street.
The time has come for policy to adjust.
It's great. He ratified what the market's thinking, but there's not a lot of big surprises either way in here, and it does tell us that we better be watching the data that comes down the pipe in the next couple of weeks.
Of course, he was mute on sort of the size of the first cut and 25 versus 50, which I know the financial markets are very focused on. But in some sense, that's not the right question for this period. It's really about now we're starting a new phase.
America, we are not going back.
Guys, we are finally through sort of the opening act here, and now we're getting into the home stretch, about 75 days until the election. And it is a dead heat. I mean, it is. I looked at the betting markets today, 49.2% for Trump, 49.2% for Harris. I mean, just as tied as you could be.
We got 1 hour to go until the market close. So let's take a look at the major averages here. And we do have a rally, even though Jay Powell delivered a message, pretty much what the market expected, but with a sort of clarity here that indeed the pivot has arrived and cuts are coming. So we're seeing stocks gain here, a little bit of a range in today's session, a little bit of bouncing around. Right now, the Dow is up 354 points, about 0.9%. The S&P up about 0.8%. The Nasdaq up a little better than 1%. The equal weight index also hitting an intraday record, I believe, today. So it's not just dominated by one group. It's a pretty broad-based gain.
Yeah, the broadening out of the market, that's a narrative we've been talking about quite frequently there. But Julie, I want you to hit the 10-year Treasury because that's hovering near the lows of the year. If you look at a year-to-date there, right around 3.8%. Of course, like we've been talking about, there is this expectation that the Fed was going to cut rates in September. Fed Chair Powell all but confirmed that. Now the question becomes, at what pace are we going to see those rate cuts, and just how much of a rate cut we will see in September? And then across the sector-wise too, I mean, pretty much everything was in the green. I believe consumer staples was that flipped in the green now too.
Well, unchanged. I guess, but slightly up.
But yeah, I mean, real estate really leading the gains here. Obviously, that helps with the rate cuts that we're seeing. We had positive new home sales data today as well. So positive outlook on the market. It seems from an investor perspective, shareholders, investors, they got what they wanted out of Powell today.
Yeah, and the sort of soft landing narrative appears to be in place here. There's another group that I want to highlight here that we're seeing a lot of action in. That is in the banks. The S&P financials look like they could close at a record today, and you see all green among the big banks here. And we've also got regional banks that are higher. I think that's right here. Regional banks also really surging today on this outlook from the Fed that they can sort of have this soft landing where we're going to have rates come down, but the economy will remain relatively healthy. And then home builders as well. If I can find those on the screen. We got a lot of tabs here, folks. It's like when you have a million tabs on your web account.
Yes.
Anyway, you get the point. I do want to circle back around to one other asset class that we are watching, and that is currencies, because we've got some interesting moves here in the dollar, which has been falling. This is the euro versus the dollar, so the euro going up, the dollar going down, and that's something that a lot of strategists have also been paying some attention to here.
Yeah, and even Bitcoin is in the green today, too.
Bitcoin in the green.
Not much in the red.
Oil in the green.
Yep. Gold.
Gold in the green. And everything rally. It's back. Yes. Let's bring in Yahoo Finance's Josh Schaefer for more on how Wall Street is reacting to Fed Chair Jay Powell's remarks today. Josh?
Hey, Julie. Yeah, I mean, you just called it an everything rally, and I think you're seeing that sentiment across Wall Street economists with how they're reading what Chair Powell had to say. It was a pretty clear read through here. He said that the time has come for policy to adjust, noting that there's ample room for the Fed to respond. And that's essentially what economists are saying. They're saying that the Chair Powell opened up the door for Fed rate cuts, and now the question is, how wide open is that door and how far is the Fed going to go? So sort of the interesting thing that people are stuck on here is the 25 versus 50 basis point cut debate for September. Renaissance Macro's Neil Dutta highlighting that Powell did not use the word gradual. Remember, some other Fed officials earlier this week had referenced gradual cutting. By him not using that word gradual, to Dutta, that means he's sort of providing optionality to do potentially larger moves. And then the key question among economists, Goldman Sachs highlighted this, several other firms also highlighting this, is basically the August jobs report. We went from waiting for today, but a lot of people are like, September 6th is probably when you're going to learn more about what the Fed's going to do. And now we're fully just, let's see what happens on September 6th. Is that jobs report weaker than expected? I just looked right now, we're looking at 155,000 job ads, and for the unemployment rate to come down to 4.2%. We're 2 weeks out, that might move. But expectations are for us to get a look of the labor market that will be a little bit better than what we got in July. And if that happens, economists don't feel like the Fed will go by 50 in September.
Yeah, I think the ample room to run here when it comes to mitigating risk, that was language that really stuck out to me, because basically he leaves the door fully open for a 50 basis point cut there, not just a 25 basis point cut. I mean, markets are pricing in around 100 basis points of rate cuts through the end of the year, and he didn't necessarily push back on that. And I think that's a narrative that we're going to see not only in September, but throughout multiple of those Fed meetings.
Just to put a fine point on that for a minute, when we talk about 100 basis points of cuts, a full percentage point cut, there are only 3 meetings. So that
50
would have
has to come somewhere.
50 has to come somewhere. I just want to emphasize that. Because even if it's not in September, the market is expecting that there will be that labor market deterioration at some point that will then trigger a 50.
The interesting part of that to me too, Julie, is so the market is expecting some level of labor market deterioration, right? But is it actually going to like when we see some level of labor market deterioration? I think is perhaps a broader question that's going to be interesting. It's going to depend on what levels we're at. Things like NVIDIA earnings are going to decide that, right? But if we're sitting at a record high and we get another weak labor report, we know how that went last time for the stock market, and maybe it doesn't go well again, even if it means you're getting these cuts.
Yeah, I don't know. If it means you're getting, I don't know. I guess we'll see. And we'll talk to our guests about that today.
We also see the lagged impact, right, of monetary policy as well. So even if we do see a 50 basis point cut, that could still mean a bumpy road potentially through the end of the year. And I feel like markets are expecting things to be good through the end of the year. So how will they react if that does in fact happen? But Josh Schaefer, thank you so much for joining us. The annual Jackson Hole Economic Symposium has Wall Street abuzz. Fed Chair Powell signaling the central bank is about to start a rate-cutting cycle. Powell also vocalizing the ample room the Federal Reserve has to respond to potential economic risks.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
For a closer look at the state of the economy and the risks, we have Oxford Economics Chief U.S. Economist Ryan Sweet. Ryan, thank you so much for being here. I'm looking through your notes right now. You are forecasting a 25 basis point cut in September, but we still have an August jobs report before that. And I'm curious, in your view, if we see that come in below expectations, is that going to set off a panic button among FOMC members that maybe were thinking in their heads they wanted a 25 basis point cut, that we could potentially see 50?
I don't know if it will send off a panic button, but it would clearly support the Fed going a little bit more aggressively in September. I mean, the Fed is arguably maybe a little bit behind the curve, and to get caught up, if we do in fact have a weak August employment number, they may opt to go with 20 or 50 basis points. And I think that was really the message from Powell's comments today, is that he didn't tie the Fed's hands or front run the rest of the FOMC. They want optionality in the fact that they're going to remain very data dependent. So we can kind of put the inflation numbers in the backseat, and everything is about the jobs numbers.
Ryan, it's Josh here, and you mentioned putting those inflation numbers in the backseat, but I'm curious, we have PCE coming out next week, right? How are we supposed to be thinking about those releases moving forward? Yes, it seems like the Fed has certainly shifted here and more concerned about the labor market, but how much do those inflation releases still matter, and do we still need to see something like core PCE coming down?
No, the Fed clearly wants to see inflation continue to accelerate, so I don't think, the Fed's going to ignore the inflation aspect of their dual mandate. It's just got a smaller weight in their reaction function because, as Powell alluded to today, they're feeling a little bit more confident and comfortable with where inflation is headed. It's not going to be a smooth, easy ride. There's going to be bumps along the road with the inflation numbers. But overall, looking at the job market, looking at nominal wage growth slowing, all indications point towards inflation getting back to the Fed's 2% target. I mean, if you already look at the PCE deflator, which that's the Fed's preferred measure, it's within spitting distance of their target. And I think that's why they're shifting more of their attention towards the labor market side, the full employment part of their mandate, is because if this soft landing is going to occur, they got to make sure that some of the fissures that we've seen in the labor market don't turn into anything worse.
Well, and Ryan, how motivated is the Fed to attack that aggressively? I thought it was interesting today, some commentary from Krishna Guha, the vice chair over at Evercore ISI, and he said Powell nailed his colors to the mast on the soft landing. In other words, Powell's legacy is effectively perhaps this at this point. And so if there is any deterioration, do you think that the Fed will be pretty aggressive when it comes to addressing that?
Yeah, I think history tells you that, when the economy suffers a growth scare, the Fed doesn't hesitate. They'll aggressively cut interest rates. I think one thing to keep in mind is that, this easing cycle is more akin to a normalization of interest rates. The Fed funds rate is not in equilibrium. They need to get it back down to roughly where it should be in the long run. In past cycles, at least for the last few, those have been panic moments. That's been break the glass with a financial crisis in 08, 09, a pandemic, and the Fed aggressively cut interest rates down to zero as quickly as they could. This time around, the Fed, I know he didn't use the word gradual, but it's not going to be, what we saw during the pandemic or financial crisis. The Fed's going to be more measured in their pace of normalization, because really what the Fed's trying to do is get interest rates back down to where they should be in the long run.
Ryan, I'm curious what you think interest rate cuts do at this point, right? If we're talking about a 25 bips cut in September, a 25 bips cut in November, it's not that aggressive, right? We are talking about gradual to some extent. How much does that help the areas of the economy that are struggling? Does that really ease policy enough to help keep growth going at this point?
Well, first thing, I think the economy is in a pretty good spot. GDP growth, for the rest of this year, for next, is looking like it's going to come in around 2%, which is the economy's short-run potential. Essentially, think of that as our speed limit. 2% is roughly where we should be growing. There are parts of the economy, as you alluded to, that are struggling. One's housing, one is vehicles, for example, and they're very interest rate sensitive. So, just even a little bit of a decline in interest rates will help those segments of the economy. Take, for example, housing. Every little wiggle in mortgage rates that we see this rush into home buying, existing homes, new homes. It's not a cure-all. These parts of the economy are still going to struggle because interest rates are still very elevated. The Fed still has its foot firmly on the brake. But I do think it will help the part of the consumer that I'm most concerned about, which is low and mid-income households. So as the Fed brings down, the Fed funds rate, credit card interest rates are going to come down, and that will provide some, almost immediate relief to those households that are struggling under the weight of still, elevated prices, a softening job market, and weaker nominal wage growth.
Ryan Sweet, thanks a lot. Appreciate it. Have a great weekend.
You too. Thank you.
We want to check in on shares of Apple right now. They are edging higher with less than an hour before the close. The tech giant reportedly looking at September 10th as the date for its biggest product launch of the year. That's according to reporting from Bloomberg. Apple, of course, set to unveil its new iPhone, watches, and AirPods. And if the timeline matches previous launches, those devices would then go on sale on September 20th. Separately, Apple getting a vote of confidence from billionaire hedge fund manager Dan Loeb. He says there's upside for the stock, especially if it can harness AI for its iOS operating system. We talked about this actually yesterday as part of a note from Loop Capital. Ananda Barua talked about how the AI cycle, because of the large install base of iPhones, could be the sort of next unlocking of growth for Apple.
Yeah, that makes perfect sense to me. And we talk about the AI cycle, we talk about the upgrade cycle for the iPhones, obviously very critical for Apple. Now, if we get that September 20th release, that's going to feed into the company's current quarter, fiscal fourth quarter results. They do expect sales to grow about 5% year over year. Of course, that's slightly below what we'll see from the holiday season. That's the quarter after this current one. And that's predicted that revenue will climb 7% 8% year over year. And that makes sense too, right? Especially if we get new iPhones, holidays, you want to upgrade your phone. I always end up missing the upgrade cycle. I do it like a year before. I should just wait.
Oh, yeah.
You know, like it always just comes.
I have a 15 that I just got, but it'll have the AI capabilities, I think, when they roll them out.
Right, and then
it's
the
like
iOS,
the one.
right.
It's the one that. It's 15 and then above.
15
or what's
above.
else. So I lucked into it this
There you
time
go.
around. But it's not expected that the hardware itself is going to see a huge revamp this time around. It sounds like, according to Bloomberg's reporting, that the watch and the AirPods maybe will have a little more of an upgrade. So we'll have to see what they say.
Yeah, I mean, wearables, they are a really important part of Apple's business. And, you know, services have really done well for Apple, especially as we've seen the hardware sort of be a little sluggish recently. But obviously, whenever we have these upgrades, you usually see an uptick there.
Yeah, and just quickly mentioning Dan Loeb, who in a letter to shareholders obtained by Yahoo Finance, talks about his investment in Apple. And Loeb of Third Point says, if Apple can execute on this opportunity, meaning the Gen AI opportunity, the monetization form factors will follow and have the potential to increase Apple's earnings meaningfully. And he said this is going to be a relief because the last few years have been stagnant in terms of those numbers. So it's interesting.
It's all about the AI.
Yes. We're just getting started here on Market Domination. Coming up, best day ever. Cava stock sees its biggest one-day jump after the company raised its full-year guidance. We're going to take a closer look at the restaurant chain bucking broader industry trends. And starting at 4 p.m. Eastern, we've got live coverage from Jackson Hole, Wyoming. Our own Jennifer Schonberger will be speaking with several folks on the ground there, including the Atlanta Fed President, and Jared Bernstein, White House Council of Economic Advisors Chairman. Sticking around, more Market Domination is coming your way after the break. Markets looking to cap off the week on an upbeat note thanks to Fed Chair Jay Powell, who said this morning the time has come to cut interest rates. Our next guest sees a soft landing on the horizon. That's partly because of technology. Joining us now, Kim Forrest, Boca Capital Partners founder and chief investment officer. Thanks for being here. So let's talk first of all about the Fed Chair's comments this morning. The market obviously happy about it, not just stocks, but kind of across the board. We're seeing a rally here. What do you think was so welcomed by investors here? Because what he said kind of confirmed what people were expecting.
Sure. Well, we've seen the jobs market kind of degrade, and let's just take the recent correction off the table. I think a lot of people have understood that there's some weird math that goes on there, and that the statistical adjustments need to be adjusted. So that wasn't a big surprise, but you can, if you watch the jobs numbers and JOLTS and especially unemployment, they've been going in the wrong direction. And I think Powell is incredibly clear on what his objectives are. And first, it's a dual mandate of job, full employment and stable prices. And as he has been saying, inflation was a big hazard, and they had to address that first. Now that feels like it's coming under, a little bit of a relief, going in the right direction for a number of months now. Jobs are going in the wrong direction, and to correct that, he's going to have to lower rates. We all anticipated it, and he said it. He said what we were all thinking. So he gets big kudos for being Mr. Obvious.
Mr. Obvious saying what we were all thinking, but now it's a debate of whether or not we're going to see a 25 basis point cut or a 50 basis point cut. Is there an argument to be made that a 25 basis point cut would actually be more preferable for markets because a 50 basis point cut might signal panic that the economy is slowing faster than anticipated?
I think you're right, but guess what? We're going to have to look at the jobs numbers and then the inflation numbers and all the other kind of health checks that we will get as statistics on the economy between now and the time the Fed meets. The thing that I've taken great comfort in, maybe over even Janet Yellen, is Powell has been very explicit that they are data-driven, and it certainly seems that way. Even in his speech where he walked us through the history of inflation, how they thought it was transitory, he was kind of funny in that math joke kind of way, saying we were all in that ship, Anyhow, he said, here's why we had to recant that and say, oh, this is a problem and we're going to raise rates. So again, he went back to the data. He is data-driven, and I think investors need to be too.
So Kim, let's get to the technology side of the equation in your view, because if we're going to have a soft landing, what role does technology play in that?
So I think it plays a huge role. And I think the Fed gets some credit, but I think the way businesses are structured by and large, not just in the US, but around the world, really deserve a good looking at and some credit for a soft landing. Here's what I see. Back in the 2010 to 2019 timeframe, a lot of economists and investors were looking for the next recession that never came. So I kept asking myself, where is that recession? Whenever the tariffs on China were put in place, you would expect that to push us into recession when, we have a loss of demand in a lot of areas because a lot of equipment and products come from China. But no, it didn't happen. So what happened? We have good accounting systems. Companies actually know what's in their buildings and warehouses because of ERP systems that were put in place in the year 2000. That's right, Y2K, remember that? But then in 2010, companies started adopting customer relationship management software like Salesforce, but it has allowed them to understand what their pipeline looks like. And even smaller companies are looking at their pipeline and making adjustments. And I think that is going to deliver us a soft landing, or as soft of a landing as we can manage, because businesses tend to not overhire anymore because they see demand, and they don't necessarily get rid of people or just keep on building hoping that things are going to turn around, because they see the demand for their products and services almost real time.
And Kim, to your point, I mean, tech has really been a sector that has lifted this market rally, but we have seen this broadening out. And I'm curious to get your perspective, since we're getting closer and closer to that Fed rate cut. We've been operating in this ultra high restrictive rate environment. How should investors be positioning themselves for a low rate environment?
Sure. Well, a couple of sectors that really have missed out, well, not even sectors, but just areas of the market, are small caps. You know, everybody's been complaining, and I'm one of them, that the Magnificent Seven was the only thing that was driving the indexes, and we know why. We're not going to go into the math problem of that about market cap weighted indexes. But I really think that smaller companies are going to get some credibility, because do you really want to buy into Amazon that's saying, hey, things are kind of slowing and we're going to just keep on investing in, you know, the new products that we're going to roll out through AWS come hell or high water. So you're going to look for other areas. And I think the smaller names are one area that you should look at. And then the obvious things for lower rate environments are things that people borrow for. So housing, home improvement, and you know, we saw Home Depot suffering and Lowe's suffering. Maybe they'll come back. So there's lots of areas where people borrow, where they might pick up borrowing to once again spend on their housing and perhaps autos as well.
Kim Forrest, thank you so much for your insights today. I appreciate it.
Thanks.
Time now for some of the day's trending tickers. Cava shares. Cava shares, they're surging, hitting an all-time high after upbeat second quarter results. The restaurant chain also lifting its full-year guidance. Cava CEO Brett Schulman telling Yahoo Finance's morning brief earlier today on the driver behind this move.
We raised our guidance significantly, and it's a reflection of the strength we continue to see in the business. So it implies low double-digit comps for the remainder of the year. For $1 or $2 more, often at parity, you can get a bowl of fresh Mediterranean food at Cava versus a traditional fast food freezer to fryer meal. And we're seeing people trade over and trade up to us.
All right, I mean, Cava shares, the stock move here was truly astounding, up about 20%. This is the biggest jump ever, the most since June 2023. It comes after those strong earnings, more than doubled. On top of that, we have increased menu innovation like that grilled steak offering, which did help boost sales, and really the brand awareness overall. And this seems to be the narrative on Wall Street right now, just the uniqueness of Cava as a potential value proposition across various income levels, various geographies. It just went public last year, and I remember at the time, there was a lot of comparisons to a Chipotle, whether or not Cava could be the next Chipotle. And we are seeing other similar types of plays, like a Sweetgreen, for example, rising on the heels of this move. So just a lot of bullishness across the street right now.
Definitely. I mean, you have to think that some of the move today is a short squeeze. There's about 14% short interest on this stock. But nonetheless, some of it is obviously driven by fundamental optimism as well. You said this is the biggest move since its IPO, or since June of last year. That's when it had its IPO. And the IPO was then at $22 a share. So obviously, you've gotten a good return on your investment if you've bought into this thing. I was looking at some of the analyst coverage today. Lots of steak puns, by the way. Chris O'Cull over at Stifel in particular, calling out the expansion into new stores. And not only that they're aggressively opening new stores, but that they are improving unit performance as they're opening new stores. In other words, those new stores are becoming more and more profitable as they sort of learn from experience, increasing experience, even with the increasing cost of goods sold. Increasing steak is more expensive for them to buy. For example, they are still getting good margins on these stores.
The efficiency narrative is one that I think is very important when you talk about a Cava, or Chipotle, or any of these fast casual chains. You need to be able to deliver your product to customers in a way that makes sense. You need to make sure that your labor force is, paid well, but also, kind of getting their job done in a quick manner. And you wonder how AI plays into all that too, especially when it comes to some of these names.
Yeah, we'll see how that all plays out. Let's talk GE Vernova. Those shares are sliding following a turbine blade failure at an offshore wind farm near England. This is the latest incident involving the company's equipment. There was a blade collapse last month near Nantucket as well. In fact, that's sort of ended up shredding the blades, and they washed up on the beaches in Nantucket, resulted in some closures there. It's unclear what exactly is going to end up being material as a result of this. I mean, the wind industry has already been struggling a little bit. So is it going to result in a pullback in orders? That is unclear at this point. I mean, the shares are down about 2%, not a huge decline, but it's not a good look at the very least.
No, in the court of public opinion, this is not a great thing. And there's also a few things at play here. You mentioned this is a struggling industry. You have high interest rates. You have supply chain concerns that have stalled and really impact projects there. Analysts have said this is going to come down to whether or not these failures are installation issues or if it's an actual blade issue. And the company itself said it's investigating the incident. But beyond that, it just seems like there's just a few external factors here that GE Vernova is going to really have to deal with. And then, like we were saying, when you have such high-profile events like this, washing on the shores of Nantucket in the middle of summer, I mean, none of this is great.
Although the shares are up like 40% this year,
yeah.
so they have been doing pretty well before this latest setback.
Yeah, we'll have to continue to watch where shares move. Coming up, though, we'll discuss what Wall Street made of Vice President Harris's DNC speech. That's next.
I know there are people of various political views watching tonight, and I want you to know I promise to be a president for all Americans. You can always trust me to put country above party and self, to hold sacred America's fundamental principles, from the rule of law to free and fair elections, to the peaceful transfer of power.
Vice President Kamala Harris there touting a future of unity at last night's DNC, accepting the Democratic nomination for president. The VP's whirlwind campaign has been characterized by memes, momentum, and record fundraising. though a lack of policy specifics have left some wondering how, if at all, a Harris administration would differ from Biden's. For more, we're joined by Jeanette Lowe, Strategas Securities Managing Director of Policy Research. Jeanette, it's good to see you. Indeed, we still are left wondering for some aspects of Harris's economic policy besides what we know about Biden's. So when you're doing sort of the policy analysis, are you just basically looking to Biden's playbook?
Yeah, absolutely. I mean, I think that there, in a lot of ways, Harris has to abide to some extent to the Biden agenda because she is part of the administration. And she does want to separate herself a little bit from Biden, but at the same time, she is going to support a lot of the policies that are in place and some of the proposals that Biden endorsed that she is endorsing as well. But I think what you're seeing is a couple of things. So one, this is still kind of a very nascent campaign. It's only been a couple of weeks. Harris does like to be very detail oriented, so she doesn't want to rush to put out any of these policy proposals. But she's also finding that the campaign said that they don't feel like they need to put out too many details either, because at the same time, they feel like voters don't need that. They're more concerned just about what the image is that she's presenting. But I think what we're trying to think about is there's not a lot of differences between Biden and Harris, and that's what we're using to move forward. Even when she did outline some of her economic policy proposals last Friday, you still saw that they were quite in line with what Biden has proposed, perhaps even just a bit more progressive. You know, things like he was proposed a $10,000 credit to help homeowners buy or do a down payment on a house. She moved that up to $25,000. She wants to increase the child tax credit from the levels that he put it at. So she's a bit more progressive on some of these policies, but in general, we are seeing her kind of follow the same path that we have with the Biden administration. So it does still give us a reasonable path forward for what her administration might look like.
Reasonable path forward, but Jeanette, I have seen a phrase being thrown around that she's been leaning into, quote, strategic ambiguity in regards to her policy. My question, though, is how long can that last, and how much more pressure does that put on that first debate between Harris and Trump?
Right. So I think that is very important that they are specifically saying that this is something that they want to do. So they want to put some policy proposals out there. They don't want to give too much detail. They somewhat argue that voters don't need all of that detail to make a decision. They're more looking for what the broad strokes are. But at the same time, they're also trying to protect the campaign from attacks from Trump and the Republicans as well. But we do have a debate coming up on September 10th. That will be a really good opportunity for the moderators to ask questions specifically about Harris's policies as well as Trump's policies and to get more detail there. And we do expect her to put out some additional proposals, some additional details as we move ahead into this final stretch of the campaign. But I think that one of the other things that is very important for this election is it's also going to matter what happens with Congress, who's in control of the House and who's in control of the Senate, because we anticipate that it's very likely that if Harris does win the presidency, there's still going to be divided government with a Republican Senate, even if there's a Democratic House, and that is going to limit her ability to do a number of proposals that she may want to do.
Does that, though, also sort of lower the stakes on what she does promise?
Right. And I think that some of the things that, if you looked at what Biden was trying to do, he came in during the middle of COVID. So we were in kind of a recovery situation. She is kind of the view that the economy is doing relatively well so now, but you can't really propose $2 trillion of spending at this point, especially if you're looking at the current U.S. fiscal situation and what those constraints are as well. The U.S. is spending a whole lot on interest costs just because interest rates are high. The Fed will be cutting next month, but that's only going to take a little bit of that paying off. And so Congress and the president, whoever it might be, are looking forward into 2025 to a fiscal situation that is going to be much tougher to do tax tax cut extensions. You have both the president, former President Trump, and a potential President Harris both want to extend at least middle class tax cuts. They will have to pay for that. So there's going to be restrictions there. So how much spending and how many tax cuts or tax proposals you're going to be able to offer is going to be limited by the makeup of Congress, what kind of fiscal situation we're looking like, and what other situations might be involved. So what do we need to do with defense spending? What do we need to do with other geopolitical concerns? So I think that is also a realization that there may be some restraints on whatever policies she may want to enact as well.
You mentioned those tax hikes. She does plan to raise the corporate tax rate to 28%. What could that mean for the profits of these corporations and the trickle-down effect that could have on wages?
Right. And so this is something, that Biden has also proposed, again, kind of following along with the same proposals of the Biden administration. He's also proposed raising the corporate rate back up. I think overall, it might be more likely that we might see a rate go up to about 25%. So it could definitely hurt some of these companies who had seen quite a good boost to their bottom lines from the Trump tax cuts, going from a 35% rate down to a 21% rate. One of the things I think that would offset this, though, is that if we do have a tax deal, we are increasing the corporate rate, we also most likely would see a continuation of full expensing for the R&D tax credit that is currently expired. So that would help some of these companies with a lot of R&D costs offset any of the impact of a higher corporate rate. And so that's something else that we will be looking forward to. So this is going to be a little bit of a give and take situation once we actually get into the tax debate next year.
Jeanette Lowe, thank you so much. There's going to be a lot to look forward to ahead of November.
Thank you.
Now let's get to some calls of the day. Guggenheim upgrading Roku to buy from neutral. The note citing investor enthusiasm towards the company's broadening AI sales. And this is from analyst Michael Morris. He upgraded his buy rating, I should say, and then established a 12-month price target of $75 a share. That represents about 20% upside based on current levels here. Now, like we said, this broadening out of advertising is a catalyst for his buy rating. He also views Roku as a unique top-line acceleration story in 2025, especially as we see those ad dollars flow from linear television to connected TV like Roku and some of those other streamers out there. He did, however, cite some concerns, saying that leadership has been slow to take advantage of Roku's significant position in the connected TV marketplace, and that you also have increased competition, which could pressure financial performance. But overall, the growth narrative seems to be intact here, at least for analyst Michael Morris, and that will help the company over the long term.
Yeah, I mean, the stock is down a lot year to date as well, something like 25%. So this, even with today's gain, so also a valuation call as we've seen the stock pull back. Let's also talk about Raymond James, which is downgrading Topgolf Callaway brands from outperform to underperform, so a two-step downgrade here. The stock is down only about 1%, but the note does highlight the recent deterioration in same venue sales at Topgolf. Basically, he says it was a bad idea for Callaway to buy Topgolf. I mean, effectively, that's what it boils down to here. If you do a TL, too long didn't read, right, on this note. He talks about that the company's rival, Acushnet, which is still a pure play golf gear company, has vastly outperformed this company because they didn't go out and buy a venue. Now, this is an acquisition that initially looked good because Topgolf was performing really well. But as we have seen this sort of post-pandemic revenge activity and travel bump fade a little bit, Topgolf has been a victim of that. It's expensive to go there, and he argues that it's hard to be a regular at something that costs that much, right? So he's not a fan.
Yeah, that is my biggest thing. I don't know if you have a lot of repeat customers.
Right.
It's a fun thing to do once. I've went once. Have I ever gone again? No. And to your point about how they thought they were getting a good deal, I mean, they purchased it in March 2021, a valuation of $2.6 billion. And, pre-COVID, Topgolf was potentially eyeing an IPO. They had a potential valuation of $4 billion. So a really fast fall from grace here. They have tried to invigorate themselves with new loyalty programs, new games, fitting rooms, upgrades, etc. But that, of course, ups the cost. It's about $155 to reserve one bay for 2 hours, and that's before food and drink. And the food and drink, it's expensive there.
Yeah, he also points out that the company has talked about now spinning off Topgolf, but he says we fear that it might be too late. So we'll keep watching to see what ends up happening.
Swing and a miss there, Julie. I had to get at least one golf one in there. Stocks tied to the housing market, including Redfin, Zillow, and Compass, are jumping today. That's on the back of Fed Chair Jerome Powell's comments in Jackson Hole and positive housing data over the last couple of days. New home sales coming in much better than expected, and existing home sales increasing on a monthly basis for the first time in 5 months. As a result, the XLRE is one of today's best performing sectors, and home builders are eyeing a record close. Joining us now is Logan Madashami, lead analyst at Housing Wire. Logan, thank you so much for being here. Like we were just saying, new home sales clearly outpacing existing home sales at this point. Can you explain why we're seeing this dichotomy? And is there anything to decipher there about the type of buyer we have that's currently in this market?
The new home sales market is a much smaller marketplace, but they have the advantage of paying down rates, where the existing home sales market has never had a sub 6% marketplace to deal with. So the new home sales have been able to grow from the bottom of 2022, where the existing home sales have been kind of hovering around the 4 million level since then. So whenever rates fall, especially when they go under 7%, the builders tend to be able to move their products. They sell homes like a commodity, where the existing home sales just doesn't have that ability. And that's what we've seen, the difference, where this marketplace has the advantage of lower rates and the existing home sales market still hasn't had a marketplace under 6% yet.
And so are we going to then continue to see this pattern until rates do hit 6%?
You know, I think the builders will always have a rate advantage here until mortgage rates get well below 6% for the existing home sales market. Affordability is basically shot still. So the last time we could actually compare this housing market to was the early 1980s. It was actually, the affordability index was worse back then for the existing home sales market. But rates fell 2.5% plus and kept on going lower. Then home sales for the existing home sales market actually grew back then. The new home sales market, as long as rates are kind of here, will still have that advantage. But if mortgage rates fell 2% and actually stayed lower below 6%, the existing home sales market could get some traction. And we've already seen some of the kind of the positive expectations going out in the future now that the Federal Reserve will probably be in a rate cut cycle. And I think that's really important when we think about mortgage spreads, right? The spreads have been historically bad for some time. If they just go back to normal, we're a sub 5.5% mortgage market today.
And what are some of the other catalysts for the rebound that we could see in the housing market? I mean, we talk a lot about interest rates. Is it all tied to mortgage rates, or are there other things at play here?
You know, we're sitting at the third calendar year of the lowest home sales ever. So you have such a low bar to move from, but really it is rates. Like the history of nominal home prices falling, there's not a lot since 1942, but rates going down, especially coming off of a very bad affordability. We have so many buyers waiting for that rate to come down to a level where they feel comfortable and can qualify, that you could maybe get a little bit of a rush of demand when that happens. But to me, I've not seen the existing home sales market actually be able to grow sales as long as mortgage rates are above 6%. The builders, on the other hand, they've been able to do it because they can play in that field, but the existing home sales market hasn't yet.
All right, Logan, great to see you. Thanks a lot for your time.
Pleasure.
Coming up, with consumers so keen for a deal, which retailers are best positioned to benefit? We'll discuss in our Investor Playbook. some retail giants getting a lift from price-conscious consumers. Target reversing its sales slump as Walmart posts a 4.3% rise in same-store sales, while other names like BJ's feel the pressure from pricing efforts to keep costs low for consumers. So how do you play deal-seeking consumers? We're looking at how to navigate the big picture with the Yahoo Finance Playbook. R5 Capital founder and CEO Scott Mushkin joining us now to discuss. Scott, it's great to see you here. So we've obviously been talking about this theme for a while now, the so-called more choiceful consumer, more cost-conscious consumer. But it doesn't feel like all of the sort of discount retailers are benefiting equally. So what is sort of helping the ones who are winning to win?
You know, it's a funny consumer right now. R5 Capital is both research consulting business. We actually are a bigger consulting business than we are a research business. So we deal with a lot of retailers. And what I'd say is we started seeing signs of this in kind of the early spring where there was definitely pullback going on, especially, and now this has become kind of common think, at the lower end, lower middle end with the cumulative impacts of inflation. We saw a lot of weakening up there. So that's definitely something that's playing out overall. But if you look at specific companies, then it just becomes like, okay, what is a specific company doing? And one of our top picks for the last 2 to 3 years, 2.5 years, has been Walmart. And what we put out earlier this week is that, hey, it's them, not like the consumer's okay. Because their core consumers actually, according to our data, really struggling. But Walmart's doing a lot of things to improve their business. They're attracting new consumers in. Their stores are much better executed. They have Walmart Plus, which is their membership program. And they're doing a lot of things behind the scenes too, improving their logistics and distribution, improving their labor model. Labor is continuing to be an issue, the productivity of labor. So there's a lot going right at Walmart. And the good thing about Walmart is we're early innings there still, even though the stock's worked. So that's one of our favorite names. It's been our top pick for a while. So we really key on, I think, retailers that are doing self-help. And you mentioned BJ's. Even though the stock came down, that's one of our favorite names, actually. We liked a lot of what we saw in their second quarter, even though the stock came down.
So going back to Walmart there, I mean, I think of Walmart and how much it has diversified its business, right, as it looks to compete with the Amazons of the world. So if you're just, a normal retailer, I guess you should say, or you just have one thing that you're focused on, are you going to fall behind? And to that point, we've seen Walmart partner with other companies as well. Do you need to create partnerships in order to kind of cut through that consumer?
Yeah, I mean, that's an excellent question. And so right now, as we look at the marketplace, there are 3 companies that are becoming extraordinarily dominant, even more so than they have been: Walmart, Costco, and Amazon. And their business models, particularly Costco's a little bit different, but particularly Amazon and Walmart, their business models are extraordinarily advantaged, and they're becoming more advantaged. And so both companies are somewhat operating the same playbook. They're putting a lot of money into their distribution, their warehousing, their logistics, and automating them. And so with that model, their business, the more volumes they drive over those types of facilities, the better they do. And so you're really going to see, I think, both companies, it's already starting, to use price as a way to drive market share. And so competing against these guys is very difficult. And as market share grows, the flywheel that gets going is that advertising business grows. And that's very, very profitable for both companies. And so, when you look at those two firms, it's really hard not to see them gaining more and more share. When you come to Walmart, one advantage they do have over Amazon is that fresh foods business drives a lot of traffic to their stores. They've done a much better job, especially in produce, but across fresh. That drives a lot of traffic to Walmart, and that is a big advantage for them. Amazon has its own, but it is a big advantage for Walmart with those 4,200 stores selling a lot of produce, meats, and it drives a lot of traffic.
Yeah, and I guess Whole Foods doesn't do it to the same, nearly to the same extent, right? But kind of to Allie's point, how important is the bundling, right? You know, Walmart just announcing this Burger King partnership. I have to admit, I'm an Amazon Prime subscriber. I don't even know. I definitely don't use all the stuff that they have as part of that. They just like throw everything in there. But how important is that? Or at some point, do you think they're going to cut back on some of that because maybe there's not enough upside and it makes it more expensive for them?
So I think the more the better a little bit here. Like, I'm not a Burger King guy, but that doesn't matter. Like, there are going to be plenty of people at Walmart Plus that will mean something to. So I think we anticipate they're going to continue to add to the benefits of Walmart Plus as they can fund that through their advertising business, which I mentioned before. So Walmart Plus, we use all the stuff, that we cover. We participate in the programs. It's a great program. Particularly again on the fresh food side, if you're not necessarily near a Whole Foods, which Amazon has. But I do think as you look at the consumer, like how many subscriptions will they actually have, retail subscriptions? One thing that Target didn't talk too much about was the Circle 360, which is their membership. They say they're happy with it, but it hasn't really taken off like Walmart Plus and certainly Amazon Prime. So I do think, if you look at a consumer, you can pretty much do almost anything you want if you have a Costco membership, if you have a Walmart Plus membership, and you have an Amazon Prime. And I think it's, again, growing advantages for those three companies.
Scott, it is fantastic to see you. I hope you have a great weekend. I hope to see you again soon.
Yeah, good seeing you too.
Thanks.
Thanks, guys. Have a great weekend.
You too. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
There's the closing bell on Wall Street, and now it is market domination overtime. Let's see where the major averages ended the session. We did have a rally here for the major averages. So strong week for all three major averages. And actually, they finished at the highs of the session as well, up by about 1.1% on the Dow. That's a gain of 462 points. The S&P 500 up about 1.1% as well. And the Nasdaq, the gainer here, beating the others, up 1.5%. I do think it is worth noting that even though the Nasdaq gained the most today, the S&P equal weight also kept pace. In other words, it wasn't just sort of large cap tech that was towing the rest of the market along with it today. It was a broad-based gain that happened because of Jay Powell saying, indeed, we are going to start to cut interest rates. I thought it was really interesting. Our Jennifer Schonberger, talking to Loretta Mester, former Fed governor, and Mester said Powell was clear that this is going to happen, that he had hinted at it in July, but that this was the confirmation.
And that's really what markets wanted to hear from Jerome Powell. They wanted him to basically give the green light that rate cuts are coming. He didn't say how much, but he certainly left the door open for a significant amount of rate cuts. Markets are pricing in about 100 basis points worth of cuts through the end of the year. And if you just look across the sector action too, I mean, real estate, financials, a lot of those sectors that are dependent on the state of interest rates doing well on the heels of this. And we're going to have to see where that shakes out through the end of the year as these cuts come into play and how these stocks and sectors are impacted by it.
Yeah, definitely. Well, for today, they're impacted well.
Positively.
All right.
Yes.
We're going to send it out now to our Jennifer Schonberger, who is in Jackson Hole, Wyoming. Jen?
Thanks so much, Julia. I'm joined now by the president of the Atlanta Federal Reserve, Raphael Bostic. President Bostic, thanks so much for sitting down with me here in Jackson Hole.
Well, thanks for giving me some of your time. It's good to be here.
It's good to see you in person for once.
Exactly right.
Fed Chair Powell said earlier today that the time is now to adjust policy. Is a 25 basis point rate cut in September a done deal?
I wouldn't say a done deal. You know, one of the things I would say is we're trying to be data dependent as much as possible. And what we've seen over the last 2 or 3 years even are surprises, head fakes, all those sorts of things. So when I think about what was appropriate for policy, for me, it's if the data come in a way consistent with what we've seen over the last couple months, that could be the most appropriate way forward. But I'm really trying to wait and see what happens.
But you're still eyeing a rate cut for September. It's on the table, right?
Well, everything is on the table at every meeting. So every meeting is live. What I'll say is this in the context of September. So for most of this year, my view and my outlook was that we'd do one cut this year, and it would be in the fourth quarter. Inflation has come down faster than I expected. The labor markets have weakened considerably, so that we're back to sort of a solid, strong place. And that's all suggests to me that it's going to be appropriate to pull forward the beginning of our rate move. So being open to something in the third quarter, September, November, is definitely in play.
So like you said, you were seeing one rate cut sometime in the fourth quarter. Now it's been pulled forward. I know you don't have all the data in hand at this point, but given your outlook, what does a potential baseline path for you look like when it comes to monetary policy this fall?
Well, that's an interesting question. I don't actually have a baseline path at this point. What I know is that we need to start normalizing our policy as our inflation gets closer to target, and to make sure that we don't see undue damage in labor markets. I think we're at a place now where you can start to see the momentum in labor markets is starting to wane. Inflation is coming down. Those are the conditions for starting to move policy.
To your point, Fed Chair Powell made very clear that the focus is shifting to the job market. He said, quote, "We will do everything we can to support a strong job market." The unemployment rate has drifted higher. Granted, a big part of that is because more people are joining the labor force. But given the push, do you worry that something more sinister is ahead? How much of this turn to the rate cutting cycle has to do with staving off a downturn in the job market as well as the economy?
Well, I'm a central banker, so I get paid to worry. So I'm worrying all the time. And I would just say, one of the things on the labor market side, we do intensive investigation to try to make sure we're on the pulse of what's happening in labor markets. So I talk to business leaders across the country. We do surveys to try to get a sense of where they are in terms of what they're thinking about labor markets. They tell us a couple things. One, they're not as eager to hire as they were a year ago. Things have definitely slowed down in that regard. But two, they don't have mass layoffs in their outlook. That they're really expecting demand is going to stay stable. They have a workforce that can meet that, and that's all positive. So the question now is, do things happen such that weakness accelerates? And that's what we're going to try to keep tabs on.
Yeah, I mean, to your point, President Bostic, historically, when we've seen a 0.5 percentage point increase in the unemployment rate from its low over the past year, it's tended to jump a lot more, and we've been in recession. So my question is, can the labor market continue to cool at this pace without a recession?
Well, I think it can. Now, we'll have to see whether it does. I mean, as you noted, a lot of the perceived weakness in the market is because more people are looking for jobs, right? So you're seeing a labor supply response, which is actually a good sign. I think if people see that there's opportunity and they're trying to chase it, that says there's optimism, there's energy, and there's productive potential. If that's the nature of the perceived weakening that we see in the numbers, we can live with that. If weakening comes because we start to see more and more businesses say, well, I got too much labor for the demand and I got to let people go, that's a different scenario, and then that would warrant a different policy response.
When I looked at the Fed minutes, there were several officials who said that the case was there for a rate cut in July. Given what you're seeing now with the job market, I mean, do you think you're late? It sounds like September is okay based on what you're hearing and seeing from contacts in your district.
Well, I'll tell you, there were contacts in my district who were telling me that we should do something in July. It just was not the vast majority of them. So, what's been interesting is that in January, nobody was saying that. And we're starting to see this evolution, which says we're on the journey. The journey is continuing such that the beginning of our normalization of policy, it needs to happen sooner. It'll be interesting over this next couple of weeks as we move into the next meeting. I'm really looking forward to hearing from our contacts, my directors and others, to see if that trend is continuing such that a majority do feel that we need to move.
So do you think the chances of a recession are still low?
A recession is not in my outlook. And, it hasn't been in my outlook for a long time. And it still isn't. Everything I hear tells me that there's enough momentum and we should still see growth in the U.S. economy.
What is your outlook for the unemployment rate? And, is there a certain level that you need to see the unemployment rate jump for you to consider faster cuts, more cuts this fall?
I don't have a specific number per se. I think a lot of it is in the labor market dynamics. A couple things that I would say. We're still seeing wages that are quite positive. They're higher than the rate of inflation. So the average American worker is making progress. Their purchasing power is increasing. The second is that we're not seeing signs that there's a large amount of layoffs that are on the horizon. And as long as that holds, I think that we can continue to see strength and that our policies can just do what they need to do to get us back to our 2% target.
So is this sort of a slower path down to neutral, more gradual? I mean, how quickly do you think you need to get back to the so-called neutral rate? And of course, there's questions around what the neutral rate is.
At all. So I would say this. Labor markets, they're weakening but not weak. Inflation is coming down faster, and some of it is because of the supply side. Some of it's because of the prices in housing are starting to move in ways that we had expected for a long time. So I think that there's a pretty good case to be made that we can get to target sometime in 2025, which would mean our policy rates need to move commensurate with that.
You mentioned housing. Do you think once you begin starting to cut rates, that unlocks some inventory on the market and improves some of the supply situation that Americans are dealing with right now?
Well, it could. So it's an interesting thing. As you know, so many homeowners today are locked in to rates that are extremely low. That does two things. One, it reduces the amount of supply that's on the market. But two, it changes the equation for families to move. So if you had a better job opportunity, it would have to be a lot better because you'd have to purchase into a higher mortgage rate. As the rates start to come down, and you're starting to see mortgage rates move right now, that calculus changes back and it normalizes. And I'm hopeful that we'll start to see something more akin to what we were seeing pre-pandemic. I think that transition is going to be slower than some might expect, but I think that's what's going to happen.
And before I let you go, Fed Chair Powell has been fervent about central bank independence and the importance of that when it comes to making monetary policy, not letting politics intervene. We've heard from candidate former President Trump. He believes the president should have a say in setting policy. Downplayed that a little bit this past week. But what's your response to that? What are your thoughts on that?
So I don't actually have a response to any of that stuff. What I would say is this. The Fed has a long history of doing what's required at the time that it's required with an eye toward the long-run trajectory of the U.S. economy. We're going to continue to do that. I'm committed to continuing to do that. And if that happens well, then the American economy will grow, it'll be resilient, it'll be strong, and Americans will continue to have the high quality of life that we've seen for many, many years.
President Bostic, thank you so much for your insight. I so appreciate it. It was great to see you in person.
Hopefully we can do it again. It's been great.
It's an open invitation.
All right, very good.
Thank you so much. That's been Raphael Bostic, president of the Atlanta Federal Reserve. We'll be right back after this.
Stocks closing higher today. The Dow up near a record high after Fed Chair Powell signaling rate cuts are likely in September. With more on the market takeaways, let's get to Yahoo Finance's Jared Blickery. Take it away, Jared.
Thank you. Powell pivots. I think that speaks a lot. And let's just get into some of the price action surrounding it. A lot of different markets participating. This is my leaders index. We'll get to sectors in a second. But first, look, Bitcoin taking the top spot. Remember way back when Bitcoin used to be heavily levered towards the Fed? Maybe it is again. We got solar energy, regional banks, unprofitable tech, home builders, IPOs, small oil, Korean stocks. And that's just the top row right there. And when we take a look at what's happened this week over all the 5 days, most of those names are pretty consistent. We're seeing a lot of small cap names and also interest rate sensitive sectors like home builders over the last 5 days. That's number one. Then regional banks, number three there. And just taking a look at the sector action supports what I'm saying. Real estate, very interest rate sensitive sector. That is in the number one spot, ties in with home builders, consumer discretionary, people buying things that they want, don't necessarily need, materials, industrials, healthcare staples. So you got an interesting mix of cyclicals and values there.
And Jared, what about the VIX? Because that's That's something that we've been discussing, just the volatility and what Wall Street can expect moving forward.
Allie, I think this speaks to it all. VIX schmicks, all right? We had a rally going on in the VIX, and it is back down. So for everybody out there, when it spikes up, the VIX, that is a negative sign for risk markets, usually. And when it's coming down, that's what you want to see. Now, here's what the VIX did today. Let me put a line chart in there, and you can see, by the way, the VIX opens about European time, 2 a.m. You can see we got a spike up here, but if we chart the price action for the entire week, here's that trend I was talking about. What is that, Tuesday through Thursday? And now it is to the downside. Now, a lot of people are going to remember that big spike we had a couple weeks ago. That is big and that is important. Now, what usually happens with the VIX, let me put a 5-year chart. We get a big spike and then we get some smaller spikes after time, and they tend to get lower and lower. So just kind of thinking about where we are with this latest cycle, you might expect to see another one here, maybe another one here. It's all about the timing, right? And fortunately, we have a seasonal map for the VIX. I've been rolling this out at various times of the year, and that is not it right there. Let's see if I can find, well, unfortunately, we don't have my VIX map. It was very beautiful, but I do guarantee you that it was showing that it perfectly captured that up spike on August the 5th. And what more can I say?
We'll show it again, I'm sure. We'll have another opportunity, Jared. And it's interesting that you talk about the VIX because when we talked to Rick Reeder of BlackRock on the Opening Bid podcast this week, he talked about going long some volatility strategies right now. So that's in keeping with what you're talking about. But let's get to your last point here. You and I have been talking about gold all week long.
Yes, we have. Gold has been hitting record highs, not big record highs, not huge movements. And to be fair, it did not hit a record high today, but it did advance about 2%. Let me just get to the charts and show you what I am looking at right here. Here is gold futures. This is a 9-month look here. If I put a 5-year chart, you're going to see how long, and maybe let's put a 10, I can show you how long it was just camping out in this big, long trading range, waiting to break out of the 2,000 level. Finally did, and now it's up to 2,547. Most of the movement was made earlier in the year in this big stretch from, what is that, mid-February to about mid-April right there. Lately, central banks have been buying gold en masse. They have been accounting, at least according to some of the analysts I follow, for most of the price action. We're not seeing retail really participate, but if retail did, that would just be a larger marginal force that would speak to gold's potential. Now, gold is known as an inflation hedge, but it needs to be an inflation hedge within a certain context of the business cycle. And it so happens that if the Fed is about to cut rates, as we believe they are, as the Fed is telegraphing, this is a good time to buy gold. So just kind of outlining all those reasons right there, underlying all those reasons, gold is a good thing to have in your portfolio if you already own it right now.
And gold did hit a record high this week, Jared, and based on where prices are at, that means a bar of gold, $1 million. So not too bad there. Jared Blickery, thank you so much for your takeaways today. Now over to Jennifer Schomburger, who is at Jackson Hole. Jennifer?
Thanks so much, Ali. Joining me now in an exclusive interview is IMF Chief Economist Pierre-Olivier Gorinches. Pierre, it's great to see you here at Jackson Hole. Thanks so much for joining me.
Thank you for having me, Jennifer.
There have been concerns that the U.S. economy is slowing following the July jobs report. Since then, we've gotten some more reassuring data in the form of jobless claims, retail sales. Nevertheless, there are some who feel the Federal Reserve is a bit behind the curve. What's your sense? Are they behind the curve? Have the chances for a hard landing in the U.S. increased?
Well, I think we should step back and look at where we are and where we were maybe, let's say, a year and a half ago. I think the really key thing here is the U.S. economy has been doing really very, very well. I mean, we've had activity exceeding expectations. We've had inflation coming down. This has been slowing down a little bit, especially in the first part of the year, but now it seems to be coming down again. And so overall, the U.S. economy is in a very good place. And so I think it's certainly true that we've seen the labor market cooling off. We've seen unemployment rates increasing. We've seen quits and hiring coming down a little bit, but coming from a position of strength. And so from this perspective, I think the Fed's approach is entirely appropriate, which is they're saying now that, there's less inflation risks. Chairman Powell mentioned that, labor market considerations are not a key driver of inflation dynamics going forward. And therefore, they'll start thinking about sustaining activity and seeing inflation coming back down further.
You heard Fed Chair Powell this morning. Given what you just said, what do you think the path for monetary policy looks like this fall, right? It's not just about, hey, they go 25 basis points in September. It's really the big pivot here, the next cycle, right?
Well, we've seen a number of central banks in advanced economies already starting to cut rates. The European Central Bank, the Bank of England last week, Bank of Canada and others. And we're seeing this path of inflation coming back closer to target. In the US right now at the IMF, we're projecting that PC core inflation will be around 2.5%. By the end of the year, we'll be back to target next year. So it's natural that there would be a move by the Federal Reserve to move back to neutral. Now, whether that will happen, of course, we expect that some of it will happen in a few weeks in September, but the pace of it will be dictated by whether there are surprises to inflation on the upside, on the downside, and to activity.
So you don't have a forecast for, hey, you see 3 rate cuts before the end of this year, sort of thing?
Well, as of our earlier reports, we're expecting maybe 1 rate cut before the end of the year. I think, given the news we've had since then, since our July update, labor market cooling off a little bit more, inflation numbers coming in and easing further, I think we can expect a little bit more than that.
Like you said, the ECB, the Bank of England, they've already started cutting rates. The U.S. a bit late to the party here. We did see an unraveling of the yen carry trade. Once the U.S. does cut, what do you think lurks out there? What sort of domino effects could we see? What are the risks to global financial markets, if any?
Well, I think there are 2 possibilities out there. One is that as the Fed is starting to cut policy rates, what we'll see is a difference in interest rates between the U.S. and other countries is going to shrink, and that would support the currencies, especially in emerging market economies, that would allow them to maybe cut interest rates further themselves because they will face less depreciation on their currency, and that's kind of a good scenario. Now, if we have a scenario where there is a cooling off of economic activity that's much sharper and the Fed needs to ease much more aggressively, then there could be a lot of volatility, and then that would be working against emerging market economies. So I really think it's the pace of cooling off of aggregate activity that will be dictating, how global markets are going to respond.
What about inflation, though? We're hearing some thunder here in Jackson Hole, so hopefully this rain will stave off. But you said in your global economic outlook just in July that inflation is expected to come down slowly because you expect services inflation to be sticky, and so that rates could remain higher for longer. Are you still sticking with that outlook now, given what we're seeing around the world as well as in the U.S.?
When you look around the world, you see that for some countries, inflation pressures remain quite significant. You look at a country like Brazil, for instance. And so I think we need to differentiate a lot across different jurisdictions. And it's certainly the case that if you look at the overall inflation numbers, they are heading in the right direction. But we do see some stickiness of inflation in services. Now, how much of that will continue, I think will depend in part on how much labor markets and activity are cooling. So right now, the projection is that this will come down and inflation in services will moderate, but that's an upside risk to inflation.
And what about your overall outlook for global growth right now? Has that changed at all? I think you were projecting 3.2% back in July for this year and 3.3% for 2025.
Well, we are currently doing the assessment for our next round of the World Economic Outlook, which will come out in October. So right now, our projection is still the July update, which you just cited, 3.2% for this year and 3.3% for next year. What we have seen since our July update is certainly some cooling off, some moderation of activity in some jurisdictions, including the U.S. But whether that will change our global outlook, we don't know yet.
I want to ask you, how do you see officials weighing the risk of rising price pressures against the danger of economies tipping into a downturn? I mean, does that raise the risk of more volatility?
Well, the mandate of many central banks is really to first make sure that there is price stability. And price stability in the sense, if you really have a lot of inflation, that is really not conducive to growth and economic activity. So bringing down inflation is a priority, I would say. Now, as inflation comes down and you come closer to central bank targets, at that point, a pivot like the one we're seeing right now with the Federal Reserve and we've seen with other central banks to take into consideration the broader picture when labor market pressures are not contributing to inflation pressures any longer or not significantly, then I think at that point you start wondering about maybe let's make sure that we have indeed a soft landing, that we don't have an overshooting on the labor market and aggregate activity.
When you look across the global economy now, what worries you most?
Well, I think we have to be concerned that the sort of pivot that we're seeing right now, where we have many advanced economy central banks are starting to ease, in an environment that is still quite uncertain, we could get some upside surprises on inflation. Some central banks may have to hold interest rates higher for longer. That could create reassessments in financial markets, that could create volatility. We've seen an episode of financial volatility a few weeks ago related to expectations of maybe faster cooling of the U.S. economy at the same time as increases in interest rate in other places like Japan. We might very well see other episodes like that, and I think policymakers should be ready for that.
So is there a risk something could break in the global financial system as we go through the fall?
It's always very hard to predict, but I think the important message is let's be ready, let's have the right buffers, let's have the right policy instruments to deal with volatility when it arises.
Switching gears a bit, in your World Economic Outlook back in July, you warned that trade tariffs could generate damaging cross-border spillovers, as well as trigger retaliation, resulting in a costly race to the bottom. We know that former President Trump has proposed tariffs on all U.S. imports of 10% and tariffs of 60% specifically on Chinese imports. How do you see that, if that policy were to go into effect, impacting global trade flows as well as the global economy?
Well, so first, look, I should be very clear. We're not going to be commenting on, economic platforms of different candidates in the context of a national election. But I think what we can say is we're always a little bit concerned about implementation of trade restricting measures, whether that's tariff or other types of measures that would come and do harm to the global economy, potentially could lead to retaliation from trading partners and an escalation of trade tensions. We've seen a lot of new trade restricting measures that have been implemented in the last few years. We are concerned that it might at some point weigh on growth, weigh on global trade, and slow down the kind of growth that we need to be able to address some of the challenges we're facing. So certainly we would recommend that a lot of moderation be expressed in that area.
All right, well, Pierre, we'll leave the conversation there. Thank you so much for your insight, as always. It's great to see you here in Jackson Hole.
Thank you, Jennifer.
Stay dry from the rain. That's Pierre-Olivier Garinchez, Chief Economist of the IMF. We'll be right back after this.
Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton. Fed Chair Jerome Powell delivered his keynote address at the central bank's annual retreat in Jackson Hole, Wyoming, and he made it clear the time has come for policy to adjust. Powell stopping short of giving specifics on how much the Federal Reserve would cut, a detail markets seem split on. And just moments ago, Atlanta Fed President Raphael Bostic telling our own Jennifer Schonberger that 25 basis points is not a done deal next month, but also maintained that he does not see a recession on the horizon. Joining us now, John Hilsenrath, Serpa Pinto Advisory founder and author of Yellen, about the woman who is now the Treasury Secretary, but of course was the Fed chair. John, it's good to see you. Thanks for joining us.
Thanks so much for having me, Julie.
So, you have tracked the Fed for a long time. How would you sort of place this Powell speech compared to some of the ones we've heard from him over the past few years?
Well, I think one of the things that Powell has done in Jackson Hole is that he's been very plain spoken about where he stands and where he believes he's going. A couple of years ago, he kind of put a flag in the ground and said that the Fed will do whatever it takes to get inflation down to the 2% target, even if that required a recession. What struck me most about today's speech, it wasn't the time has come line. A lot of people are talking about that. It was when he said, we do not seek or welcome further cooling in labor market conditions. He really emphasized labor market conditions today. And to me, that sets the tone for what happens next. The market is really focused on, is the Fed going to cut by a quarter point or by a half a point? Are they going to cut every meeting or every other meeting? What Powell is telling us is that if he sees the unemployment rate going up further, it was 4.3% in July, then he's going to look to be more aggressive. He does not seek or welcome further labor market cooling. And so what that means is he'll be aggressive if he sees it.
Right. I mean, in other words, we're still data dependent, John, right? It's just there's different data that we are now dependent on, that we're tilting now towards labor data versus inflation numbers. And that means that the next jobs report is gaining even more importance.
That's absolutely right. And this is a shift that's been going on since Powell spoke to Congress back at mid-year when he talked about the balance of risk becoming more balanced, about the Fed becoming more concerned about labor market conditions as opposed to inflation cooling. And I think there's a really important point here for investors to consider. Over the last 2-3 years, a lot of the volatility in markets has happened on inflation days when CPI reports have come out, or when PCE, personal consumption expenditure reports have come out, because those reports have really dictated how the Fed was going to respond and what it was going to do with interest rates. What we're seeing now, and the marker that Powell put in the ground, was that they're now looking really carefully at jobs. So I think we're going to see more volatility on jobs days over the next few months than on CPI days. If you're looking to buy or trade volatility, that's the day you want now. The first Friday of every month is going to set the tone for the Fed policy outlook for the next few months.
Yeah, makes sense. I mean, do you also think that the market and Powell are now more on the same page than they have been at any time yet in this cycle, right? I mean, we came into the year with the market pricing in 7 cuts. At the time, even, there were some folks saying there's not going to be any this year. So there was a big dispersion, but the market generally was looking at 7. He was saying the same thing all along, and gradually the market seemed to come to his position.
Well, I think the market might be a little out of line. I have to look at where Fed futures end the day. But earlier in this week, the market was pricing in a full percentage point of interest rate cuts through the end of the year. Now, so you have to back that out and figure out, all right, well, how are we going to get there? They would have to do at least a half a point at one meeting in order, because there's only 3 left, right, in order to get to a full percentage points of cuts by the end of the year. I think what Powell is setting himself up for is, 2 or 3 rate cuts this year, unless the job markets come in weak, unless we see that unemployment rate go up to 4.4 and 4.5, and then the market is going to get its half percentage point cut. But there's a chance that the market is looking for a little more than Powell was ready to do. We're going to know a lot more on the first Friday of September.
Yes, we are. We'll be anxiously looking for those numbers. John, I also want to ask you about politics. Every Fed governor we talk to says, we heard from Loretta Mester, for example, former Fed governor today, and she said politics does not enter that FOMC meeting room. Is that disingenuous, or do you think that is indeed the case?
I think politics, and in particular former President Donald Trump, because he's been so critical of the Fed, is kind of like Voldemort in the Harry Potter series. You don't say the name, and you don't speak it out loud, especially in policy meetings, because officials know that these transcripts are going to be made public within 5 years. So you don't talk about politics. And I think but it's also kind of hard to ignore. I think the Fed is in it. I think that the Fed started the year hoping it could get through the end of the year without really making much noise or doing anything. And the data have driven it to where they think now is the time to cut rates, and they're going to do it regardless of the politics. I think the situation that they've driven themselves into, and that the economy has driven them into, is that they're damned if they do and they're damned if they don't, right? So if they don't cut rates in September, they're going to have Democrats, and we've already seen some on the Hill, like Senator Elizabeth Warren, saying, you're too late. You should have been doing this a long time ago. You're hurting the economy, and that's going to hurt Democrats. If they go ahead and cut rates, then you're going to have Donald Trump and Republicans saying, you're interfering with the election. You shouldn't be doing anything until after the election. I think because because of this kind of two-sided risk for them, they're in a position where they really do have to follow the data and do what they think is right. I think in their heart of hearts, and if you looked at their forecast, say a year ago, they were kind of hoping that they would get through election season and not be a story.
Right.
But they can't control that.
Yeah, and if they didn't cut at this point, they would have a lot more than the Democrats that would be breathing down their neck. I think market participants would be very disappointed, to say the least. John,
there'd be quite a number of unhappy bond stock traders for sure.
John, it's always great to get some time with you. Really appreciate it.
Thank you so much.
Thanks. Well, our coverage from a stormy Jackson Hole continues. We've got a conversation with Jared Bernstein, White House Council of Economic Advisors Chair. That's coming next.
Welcome back to Yahoo Finance, where our live coverage continues here in Jackson Hole with stormy clouds rolling in. I'm Jennifer Schonberger. Joining me now is Jared Bernstein, chair of the National Economic Council of Advisors for President Biden. Chair Bernstein, it's great to see you here in Jackson Hole. Thanks for joining me.
Great to be with you.
I want to kick it off with your outlook for the economy. The cooler jobs report that we got in July sort of scared some people that recession odds are increasing. Since then, we've gotten some more reassuring data, jobless claims, retail sales, though we do get a bit of a mixed picture when it comes to the consumer when we hear from different companies and their earnings reports. So to what extent do you see momentum slowing in this economy?
Well, first of all, I would say the economy looks nothing like what's behind us right here, which is stormy conditions. I think the U.S. economy is in a good place. The job market remains solid. I think consumer spending is continuing to help generate a really durable and reliable expansion. You're right that there's been cooling in the job market. That was expected. You're right that consumers are definitely pulling back a bit. But remember, those are pullbacks from breakneck paces. So what we're seeing is, and these are words we've heard at this conference, normalization. We're seeing an economy that's settling into more normal rates of growth. Something, by the way, President Biden wrote about back in March of 22, saying we should expect this as we move from just the gangbuster growth out of the trough of the pandemic-induced recession to more steady, stable pace of growth that we're seeing now.
On the job market, Chair Bernstein, we've seen the unemployment rate rise 0.5% since its low last year. Typically, when that's happened, the unemployment rate has jumped a lot more. The economy has been in recession. So can the unemployment rate, can the job market continue to cool without a recession?
Well, I think the job market, let's just talk about where it is first, is, as I said in my first set of comments, in a strong place, still in a solid spot. Now, it is absolutely the case that the last jobs report came in weaker than expected, but any month can jump around. Can be volatile, just like the weather in Jackson Hole. In fact, if you take the average over the past 3 months, you have a pace of job gains of 170,000 per month. You have an unemployment rate that at 4.3%, yes, is elevated from the historically low rate of a year ago, but still actually I think a little bit below what the CBO tells us is full employment. So these conditions can definitely prevail, can definitely persist. My take is that they're likely to do so, in part because, again, gets back to what we were saying about consumers. We have rising real wage gains now for 17 months in a row, year over year. That is easing inflation, solid wage gains. We have a 70% consumer spending economy. When you have a well-heeled consumer with those kind of tailwinds at her back, that's going to help continue the expansion apace, and that's what we're seeing.
Inflation seems to be more under control as the Federal Reserve views it. That was still an issue for many consumers, Americans. Where do you see inflation ending the year this year?
Inflation continues to be on an easing trend, and certainly a message we've heard here, including from Chair Powell, and I think everyone's forecast has inflation, say CPI 2.9 when last seen. It's the first time we've seen a 2 handle since early 2021, and we think that it's probably going to continue to ease throughout the rest of the year. Now, look, I'm not going to get into crystal balling here because, it's not a linear thing. Any month can bump one way or the other. The question is, when it comes to inflation, is the trend your friend? And I think the strong consensus is that that's the case. Now, look, at the White House, we're not central bankers. We have to think about what people and households and families are dealing with. And well, I'm sure I appreciate the fact that inflation has come down, especially with groceries. It was double digit. Last it was seen about 1%. We need to get price levels down. We have to be concerned about costs. And that's what you certainly hear the president, the vice president talk a lot about and take real action on, particularly with the prescription drugs, housing, groceries, child care, junk fees. That's very much an active agenda.
You mentioned grocery prices as the wind's about to take us down. Vice President Kamala Harris formally accepted the nomination for president last night for the Democratic Party, and she's been floating some economic ideas. Among those, a potential federal ceiling on grocery prices should there be any price gouging. Now, of course, we don't have details. We don't know what price gouging and how that's defined under her plan, but would that solve the issue? generally when we see price controls, does that not lead to shortages and higher prices?
Well, I think we should let her team give you the details. What I will say is that she did not propose price caps. She talked about taking action against price gouging in the way that any good prosecutor, someone with her background, should do, and ways in which any American who's concerned about cost should want from their president. In fact, what she talked about explicitly was more competition. You know, it made me think of this old Adam Smith quote where he says, never do two, I'm not quoting exactly, but never do two business people come into contact, then they start to conspire to raise prices. And what he said is the answer to that is more competition. She's a prosecutor going after big corporate actions that create barriers to entry in key sectors where there's not enough competition to put downward pressure on price. I think that's precisely the agenda you'd want your president to have in a cost climate like the one we've seen.
Let me ask you about housing as well. She's put forth, Vice President Harris has put forth a number of proposals when it comes to housing. President Biden has looked at increasing housing supply by 2 million. She's looking at 3 million. She's talking about tax incentives for home builders. But what about tax incentives for investors who bought up all those foreclosures following the financial crisis? I mean, that's a lot of inventory that's sitting on the market right now where you don't have to deal with local zoning to try to get that back out for Americans to buy homes again. Why not consider a tax incentive for that, for investors to get that inventory back on?
Well, actually, I mean, if you listen to her plan, one of her concerns is investors buying up lots of single-family homes, converting them to rentals and taking them off the single-family market, leading to diminished supply there. I think her housing plan, which looks a lot like the one that President Biden has in our budget, is very much targeted at increasing the supply of the housing for the bottom half, I'd say affordable housing for moderate and low-income folks. And it does involve subsidizing not so much investors, but builders. For a lot of builders in that sector, building low-income housing, building moderate-income housing doesn't pencil out. They just can't afford to make the investments in the land, the labor, the materials. But with some of the smart policies, she talked about LIHTC for multifamily housing and other subsidies for single-family homes. We think we can help make that pencil in instead of not pencil out.
All right, well, Chair Bernstein, we'll have to leave the conversation
yes,
there as the rain is coming down on us. Thank you so much.
Thank you.
That's Jared Bernstein, Chair of President Biden's National Economic Council of Advisors. We will be right back after this. Much more on the other side of this break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
The Justice Department suing property management software firm RealPage today, accusing the company of helping illegally drive up rent prices. The lawsuit alleges that RealPage software used non-public data to train and suggest higher rent prices, helping landlords artificially inflate prices.
Everybody knows the rent is too damn high, and we allege this is one of the reasons why. When companies, and in this case landlords, use a software tool to facilitate cooperation with respect to rents, they violate the antitrust laws. They make rents higher than they would otherwise be, and they prevent rents from going down.
Make no mistake, training a machine to break the law is still breaking the law. Price coordination using AI is still price coordination. And monopolization, advanced by an algorithm, is still monopolization.
In a statement, RealPage said the Justice Department's claims were, quote, devoid of merit and will do nothing to make housing more affordable. Time now for what to watch next week. A bunch of tech earnings coming out next week, including Salesforce and CrowdStrike. But of course, all eyes will be fixed on NVIDIA. That tech giant reporting second quarter results after the close on Wednesday, and a lot is riding on that print. NVIDIA has been one of the biggest drivers of returns among the Magnificent Seven. Investors will listen for any more insight into the delay of NVIDIA's Blackwell chip, which the company has not confirmed, but analysts are expecting demand for its Hopper chip to remain strong and for it to beat and raise guidance. We'll also see some more retail earnings from Foot Locker, Lululemon, and Gap, among others. And taking a look at the economy, monthly PCE data for July, that's personal consumption expenditures, that's coming out on Friday. It's a measure of inflation, and it's the one preferred by the Federal Reserve. Economists forecast it will remain relatively steady at 0.2%. That would be a slight tick up for total PCE. And finally, we'll get some more Federal Reserve commentary next week from Atlanta Fed President Raphael Bostic. It's coming after Bostic just told Yahoo Finance's Jennifer Schonberger in Jackson Hole a 25 basis point cut in September is still, quote, not a done deal. He also said that, quote, a recession is not in my outlook. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. I'm off next week, but Josh will have you for the week. Have a great night and a great weekend.